It's Friday, the 6th of February. This is your Capital Economics Weekly Briefing. My name is Neil Shearing, Group Chief Economist. David Wilder is out this week, but I'm delighted to be joined by John Higgins, our Chief Markets Economist, and Vicky Redwood, our Senior Economic Advisor, to pick through what's been another hectic week in macro markets, in particular turmoil in the equity market around AI concerns, and that's going to be the focus of our discussion. John, let me start with you. Just pick apart what's happened over the past few days and what's been the kind of extraordinary twists and turns in the stock market. We've seen a collapse in the price of the equity price of some software firms on concerns that AI is going to eat their breakfast, lunch, and dinner, as it were. And then in after hours trading on Thursday, we saw that big fall in Amazon's share price on CapEx concerns, the idea that these hyperscalers are spending vast amounts on AI CapEx and that may be unsustainable and lead to waste. Unpack what's happening in markets. What are the kind of principal concerns here?
I think you've hit the nail on the head there, really, Neil. There's sort of two issues going on. One is this concern, if you like, that the rapid advancement of AI technology is going to affect those companies in the software space, who have traditionally not had to put up with that challenge, essentially, from these rapid deployment of AI tools. And we have seen a very significant drop back in the prices of sort of software companies. That hasn't, though, actually been matched by a broader decline, I think, in technology-related companies. We did a bit of work on this in our Capital Daily earlier in the week and showed that actually, generally speaking, some semiconductor companies have been doing pretty well. Their performance has also continued to be matched more or less by companies in the sort of tech space that aren't necessarily the semiconductor space or in the software space. So it seems to be quite narrowly concentrated, and concern, as I said, as you put it, really, about whether AI is going to eat the food of these software companies. But we don't think it necessarily marks the beginning of the end, if you like, in the AI rally. This was always going to be some sort of challenge, I think, that might be posed to these companies as AI gradually became more sophisticated in the way things that it could do. But yeah, not necessarily a sign of the whole AI rally coming unstuck. Now, separate to that, of course, though, is, as you also mentioned, concerns about the huge amounts of money that the hyperscalers in particular are spending in order to try and ramp up, their capacity to roll out AI. And I think increasingly here, what we're seeing is some sort of differentiation being applied by investors based on not so much how much these companies are spending on CapEx, but whether or not that's actually showing signs of paying off. And to some extent, we're seeing continued strong revenue and earnings numbers. And in those cases, investors seem to be reasonably satisfied that these CapEx plans are delivering the goods. But I think there's an increasing amount of nervousness about whether that's true in all cases. And of course, the big thing that people are preoccupied was what we might call sort of free cash flow. That's to say the sort of difference between the operating cash flow that these companies are generating through the bottom line and how much they're actually spending on CapEx. And to the extent we have seen some sort of downward pressure on this free cash flow in the round, but again, increasing differentiation, I think, across firms now we see that in the way that the market has responded generally to the big tech results that we've had over the past couple of weeks. Quite a lot of differentiation really there in terms of some of the big tech stocks been hit pretty hard, others not so much. So I think it is increasingly a case of people trying to pick winners and losers, as it were.
And if we kind of take that and run with it, so if we just step back and think about the kind of winners and losers, is it fair to say, do you think, that there are three buckets emerging? You mentioned earlier the firms that are producing a lot of the hardware that are going into this AI boom and build out continuing to do well. So the semiconductor manufacturers and so on and so forth, that they appear at this stage still to be in the kind of bucket of winners. In the losers category, we seem to have a bunch of software firms and firms more generally where there's concern that AI might pose an existential threat to their business model and their products and their revenues over the next kind of 3, 4, 5 years. And that's what we've seen play out in the software market, for example, over the past week or so. So firms where there are concerns that AI applications are going to fundamentally challenge their business model are in the loser category, and particularly software firms at the moment. And then somewhere sitting between the two of those seems to be the hyperscalers, these big tech firms where the jury potentially is out, have been big winners so far, but now some concerns that some of the massive CapEx plans are perhaps going to be unsustainable, be wasted in some sense. Do you think that sounds fair?
I think that's reasonable categorization. Yeah, as I said, if you look at the sort of the big tech firm response to their results has been quite varied. I think if you were to, look at it overall, we've seen generally these firms continuing to meet or eclipse expectations for earnings and revenues. That hasn't been necessarily the case in all instances. But generally, I think things are okay on the sort of revenue and income side of things. But where the market's becoming at least more concerned is that, is whether the growth, if you like, in revenues is sufficiently strong to justify these huge capex plans that these firms have, which not only they have ramped up, but they're planning to ramp up by more than analysts perhaps had originally anticipated. So I think where firms are sort of demonstrating really strong revenue and earnings growth and can demonstrate that they're eating the lunch, if you like, of their competitors in that space, then they seem to be holding up pretty well. But it's those where they're announcing huge increases in capital spending alongside signs, if you like, that perhaps revenue or earnings growth isn't quite as good as perhaps analysts have been hoping for. That they seem to be the ones who are being picked upon a little bit. But your broad categorization of the sort of semiconductor firms, the picks and shovels providers, if you like, doing quite well. The software companies obviously struggling in this middle ground of sort of hyperscalers, I think is a reasonably good one. There's obviously also another part of the stock market, which is firms outside the big tech or outside the tech space, and really the extent to which they're showing any benefit from AI and profiting from, obviously, they're the ones who are, if you like, are paying money to these big tech firms to use their cloud storage, to use the applications there, in the hope that it's going to boost their productivity. So I think that's something we also need to keep an eye on, the extent to which that's actually feeding through to gains in other parts of the economy and sectors within the stock market.
Yeah, indeed. Vicky, let's just think about how all this is playing out in the real economy. Obviously, we have written a lot, and you've written an awful amount about the AI revolution and how that might play through in the real economy. And generally, we've been, I think it's fair to say, pretty optimistic, and we've been quite early on all of this as well. But the numbers that are now involved in some of these capex plans are huge. They're vast, aren't they? To what extent is that excessive? To what extent is this enormous investment required and necessary part of the rollout of a general purpose technology, if you will?
I think we do need big investment in the infrastructure and creating the conditions that will allow AI to diffuse widely across firms, across the whole economy. That's going to cost a lot of money. But whether that money ends up being money well spent depends on whether all this technology can be monetized by firms across the whole economy, buying AI tools and applications and using those. And yeah, we've always been pretty optimistic that AI is a general purpose technology. It can be used across the whole economy. It will have many use cases, many of which we probably don't even know yet. And so what we are keeping a close eye on now is the extent to which AI is starting to be used more widely across the economy, not just in the tech sector, but in different parts of the economy. And at the moment, there is encouraging evidence of a pickup in usage, particularly in the US, but in other countries too, and particularly in the tech sector, but in other sectors too. But the picture is generally at the moment still quite a relatively gradual transition. Again, something that we always expected to happen. We didn't think this was going to be a sudden, abrupt change in the economy and that overnight companies would suddenly realize they could make good use of all these AI tools. It will take time for companies to adjust and experiment and work out what works and what doesn't.
I guess another point in all of this too is that we tend to think in nominal terms, don't we, when it comes to the stock market, the equity market. But for the real economy, it's real investment that matters. And to some extent, I think you need a big wave of investment to push out the technology the supply of that technology then increases, that drives down the price, which means that you get a surge in real investment, even if nominal investment around this technology kind of levels off and potentially even falls because you're getting price declines. So you get more volume, if you like. I think it's important to distinguish the framework for thinking around investment in the real economy is very different from a framework for thinking around investment by firms and how that feeds through their balance sheets and affects their share price and so on and so forth. What about the evidence of broader effects of AI on the real economy? You touched on it earlier. To what extent do you think there's much evidence that this is starting to contribute to productivity growth? Clearly, you've had very strong productivity growth in the US over the second half of last year. How much of that's AI? How much of that is just something else going on?
The answer is probably a bit of both. It's hard to disentangle the impact of AI from other factors. We've looked into what's happening on a sectoral level. We think that there is now fairly conclusive evidence that AI is having some impact. If you look into which sectors are seeing the fastest productivity growth in the US, it does seem to be those that are starting to use AI more intensively. There are still other factors at play, but I'd say AI is definitely playing some part in that now. In other countries, I'd say there's less evidence of a pickup in productivity growth and less evidence of an AI-related pickup in productivity growth. That's not to say it won't come, but we haven't really seen it yet. But I think you would expect to be seeing it come through first in the US, given that that's where it seems that AI usage is spreading most quickly.
Yeah, Stephen Brown, our Deputy Chief North America economist, put out a good note over the past week discussing all of this, dissecting all of this as it relates to the US, and I'll link to that in the show notes. But you mentioned there, Vicky, the kind of hierarchy, if you like, of adoption, diffusion, and then adaptation to AI technology differing between countries. So the US potentially leading the way and other countries lagging. That's been a key feature of our work, hasn't it? That a lot of the analysis of AI and the impact of AI tends to take place or happen through the lens of what's happening at the technological frontier, but sometimes other countries lag in the adoption and diffusion of new technologies. And we brought all that together in what we've called our AI Economic Impact Index. I know you've been working with the team on updating the rankings in that index, and we'll be publishing that in due course over the next week or so. But give us a sneak preview. What does that say? Does that put the US kind of head and shoulders above everyone else? And if so, who's coming second, third, fourth in the race and who's lagging behind?
Yeah, the US is still up at the top. It leads in, well, the US and China are very strong on innovation, but the US is also strong on the other pillars that we look at. So diffusion of AI throughout the economy, and also the ability with which the economy can adapt to AI in terms of, for example, reallocating capital and workers to different sectors in order to adapt to AI's effects. After the US comes the UK, comes pretty high. That's third on our overall index. And also the Asian tigers generally score pretty highly. So Singapore is second, for example. One interesting thing during our update of this index is how much China has shot up the rankings, actually, since we last looked at it a couple of years ago. China was about 15th, 16th in our rankings, and now it's up in 7th place. And that's mainly due to an improvement in its potential to diffuse AI throughout the economy. We've become more optimistic on that, given evidence over the last couple of years of how effective AI is likely to be used by firms throughout the Chinese economy. So that's quite an interesting development. One caveat is that even if AI becomes widely used throughout China, that might not necessarily translate into proportionate rise in productivity. So it doesn't necessarily have a big bearing on our long-run forecast for productivity growth and economic growth in China.
Yeah, again, Leah Fahy in our China team wrote a big piece on China's AI adoption, which again, I'll link to in the show notes. John, let's just finish with you, though. Clearly, it's been a tumultuous week in financial markets. We're talking on Friday morning, London time, and things appear to be a bit calmer. FTSE up, some of the tech stocks rebounding, and S&P futures up a little too. What are you going to be watching for in the week to come, and what should investors have on their kind of radars over the coming week?
I think the news as far as the AI story is concerned is over now, at least temporarily. We don't have any sort of May results coming up in the coming week. We've now seen the biggest of the hyperscalers report over the last couple of weeks. We obviously will get some more big tech results in due course. For example, on the sort of semiconductor front, I guess, world's largest company, NVIDIA, will be reporting later this month. But certainly next week, I think things will probably quieten down on that front, give investors an opportunity to process all of this. We do, I believe, have a delayed sort of employment report. So the focus may just go back to sort of the state of the economy in the US. And I think that's also something that's pretty important in the context of this whole AI story and how sustainable the rally is in the stock market. We shouldn't lose sight of the fact, for example, that the sort of the dot-com bubble that burst at the end of the 1999s, the beginning of
2000, that was a time that was coinciding with a tightening of US monetary policy. And of course, it was followed by a recession a year or so later in the US. So the sort of overall economic backdrop, if you like, wasn't very favorable for that rally that we were seeing at the time to continue, and arguably was a sort of a straw, if you like, that broke the camel's back when it came to the rally. So I think it is pretty important how the economy is doing in the background, and that may well be an important determinant of how long this rally in the stock market on the back of AI can continue. For what it's worth, we obviously think the economy is holding up pretty well. We don't see the economy necessarily standing in the way of this rally in AI resuming in due course.
Right, okay. A tumultuous week, but an optimistic note to end things on. We'll leave it there. Thanks very much, John. Thanks very much, Vicky. Thanks very much for listening. I'll link to those pieces in the show notes on AI adoption in both the US and China. And keep an eye out for Vicky's AI Economic Impact Index rankings that will be published over the next week or so. For now, though, thanks very much for listening, and we'll speak to you again next week. Goodbye.